Welcome to Finance Frontier. If you want your first $100 a month from dividends, here is the truth. It is not a dividend problem. It is a consistency problem. And that is good news because consistency can be built. $100 a month is $1,200 a year. Suddenly, the goal stops feeling vague. It becomes a math problem, a portfolio target, and a roadmap you can actually follow. At a rough 3% portfolio yield, you would need about $40,000 invested to generate $1,200 a year. At 4%, it is closer to $30,000. At 5%, about $24,000. That does not mean you need to chase the highest yield you can find. It means you need a plan, a simple one, a repeatable one. Because the fastest way to get discouraged is to treat dividend income like a shortcut instead of a process. So what does the roadmap look like? 3 steps. Choose quality dividend-paying assets. Reinvest the payouts. Track the progress over time. That is the whole engine. Simple on paper, powerful in practice. First, choose dividend payers that can actually support the journey. Beginner investors often make the same mistake. They chase the biggest yield and assume that means the best income. It does not. A high yield can be a warning sign if the business is weak. A dividend is only as good as the company behind it. That is why quality matters more than hype. A useful way to think about it is this. You are not just buying income today. You are buying the chance for that income to last. Companies with a history of growing and initiating dividends have often delivered stronger long-term results with less volatility than companies that cut or eliminate payouts. That is the kind of stability beginners need. Not perfection, stability. And here is an important reality check. Dividends are not guaranteed. During stress periods, companies can cut them, freeze them, or stop them entirely. In one rough quarter during 2020, U.S. indicated dividend payments fell sharply as businesses were under pressure. That is why a smart roadmap never depends on one stock, one sector, or one payout schedule to cover your bills too early. Diversification matters. Patience matters more. Also, do not confuse dividend income with free money. A dividend is cash coming out of a business, which means the company's value changes when that cash leaves. So instead of asking only, what yields the most, ask, what is the quality of the business and what is the total return? That shift protects beginners from chasing numbers that look exciting but do not hold up over time. Now comes the step that makes the roadmap work: reinvesting dividends. This is where small payouts stop being small. When you reinvest, every dividend buys more shares. More shares create slightly larger future dividends. Those dividends buy even more shares. That is compounding, and compounding is where long-term dividend investing starts to feel almost unfair. Dividend reinvestment plans, or DRIPs, make this easier. In plain English, they let you use your dividend payments to buy more shares of the same investment automatically. Some brokers can even reinvest into whole and fractional shares, which helps every dollar stay active. Nothing sits on the sidelines. Every payment gets back to work. This is not just theory. Long-run market history shows why reinvestment matters so much. Since 1960, a huge share of the S&P 500's cumulative return has come from reinvested dividends and compounding. That means the real growth story is not only about price going up. It is also about the dividend stream quietly buying more future growth along the way. In other words, reinvesting early is not optional if you want the full effect. It is the strategy. There is another reason dividends have become such a powerful part of personal finance. Over the decades, dividend income has grown into a bigger share of household income, while interest income has faded in importance. That tells you something important. Dividends are not just a niche investor topic. They are a real cash flow tool that has quietly become part of everyday wealth building. Now let us talk about tracking, because progress without measurement feels invisible. If you want to reach $100 a month, you need to know where you started. Write down your portfolio value, your current dividend income, your average yield, and your monthly contribution. Then update it regularly. Monthly is ideal. Quarterly is the minimum. Your tracking does not need to be complicated. A simple spreadsheet works. So does a portfolio tracker. What matters is that you can answer 3 questions at any moment. How much have I invested? How much income is coming in? And how close am I to the next milestone? When the numbers are visible, the goal becomes real. And when the goal becomes real, discipline gets easier. This is also where taxes matter. In a taxable account, reinvested dividends are still taxable, even though you never touched the cash. So DRIP helps compounding, but it does not make taxes disappear. Many qualified dividends may also be taxed at favorable federal rates, depending on your income. The point is not to fear taxes. The point is to plan for them so your roadmap stays clean and realistic. And if you want the simplest mindset possible, keep this in mind. You are not trying to win the next month. You are trying to win the next decade. The most reliable dividend investors are usually not the loudest ones. They are the ones who keep contributing, keep reinvesting, and keep tracking the story 1 month at a time. So here is the roadmap again. Step 1, buy quality dividend-paying assets, not just the highest yield. Step 2, reinvest every dividend you can. Step 3, track the growth so the progress stays visible. And step 4, maybe the hardest one, stay patient long enough for the math to work. Because that is what this $100 a month goal really is. It is not a fantasy. It is a target portfolio, built one contribution at a time, one dividend at a time, one reinvestment at a time. The money grows, then the confidence grows, then the roadmap starts to feel natural. At Finance Frontier, the message is simple. Small, consistent actions can build real income over time. Stay focused on quality, keep reinvesting, and let the numbers compound. Subscribe for more Finance Frontier roadmaps.